If you live in Utah and you're collecting Social Security or you're about to, there's a tax credit on the books most retirees don't know exist. And the ones who do know often don't claim it correctly. The difference for a couple in the right income range can be thousands of dollars a year, every year, for the rest of your retirement. I'm Nico, and for 16 years, I've helped families think more clearly about retirement. Most states don't tax Social Security at all. There are fewer than 10 that still do, and unfortunately, Utah is one of them. We've got a flat state income tax, and Social Security benefits are included in your taxable income at the state level, the same way they are at the federal level. For a lot of retirees, that's a surprise. They've heard for years that some states are tax-free for retirees, and they've assumed that Utah was one of them. And then they get to retirement, and they find out the state takes a cut every year. The dollars aren't enormous on a percentage basis, but they compound over a 25 or 30-year retirement. And most people are having money on the table left that they didn't want to leave on the table. So here's the part nobody tells you. Utah has a Social Security tax credit specifically designed to offset that tax for retirees under certain income thresholds. It's a real, current, on-the-books credit. The Utah legislature has expanded it more than once over the last few years specifically to try and make the state more retirement friendly. The way it works is straightforward. If your modified adjusted gross income, that's the most income from the most sources, is below a certain threshold, you get a full credit on the state tax owed on your Social Security benefits. As your income goes up, the credit phases out, and above a certain ceiling, the credit goes away entirely. The specific numbers shift year to year as the legislature updates them. I'm not going to lock them into the video because by the time you watch it, who knows, maybe they changed already. But the structure is what I want you to understand. So below the thresholds, full credit. Phasing out as income rises, gone at the top. Here's why this matters more than the dollar amount suggests. The credit phases out based on income, which means how you structure your income in retirement directly affects whether you'll keep paying certain taxes or keep the credit. If you're pulling everything from a traditional IRA, fully taxable distributions, you're stacking ordinary income on top of Social Security, and you might be phasing yourself out of a credit you'd otherwise qualify for. If some of that income comes from a Roth IRA as an example, or from long-term capital gains taxed at lower rates, or from a strategic withdrawal sequence designed around the threshold, you might keep the credit entirely. This is what I mean when I say a coordinated plan is worth more than the sum of its parts. The Social Security credit isn't a tax issue, it's an income issue. The income issue isn't an investment issue, it's a planning issue. And the planning has to happen on the front end, usually in the year or two before you start drawing benefits. Sometimes 10 years before. You want to actually move the needle, so the planning has to be proactive. Let me put a number on it so it lands. If we're talking about a typical Utah couple receiving around $45,000 a year in combined Social Security benefits, the state tax owed on that without the credit runs roughly $1,500 to $1,900 a year. Over a 25-year retirement, that compounds into $40,000 to $50,000 in state taxes alone. If you can structure your income to qualify for the credit, you keep most of that. If you can't, you don't. That's not a windfall. It's not some get-rich-quick strategy, but it's also not nothing. And it's exactly the kind of thing an investment-only relationship will never surface, because it isn't an investment question. It's a tax and income question that requires somebody to be looking at the whole picture. If you live in Utah and you're within 10 years of taking Social Security, 3 things to do this year. First, pull last year's Utah state return and see whether you took the Social Security credit or whether you're projected to qualify when you start your benefits. If you've already retired and you've never seen this credit on your return, that's a flag worth following up with your CPA. Second, get a clear picture of your income sources in retirement, not just how much, but where the income's coming from, whether it's traditional IRA money, Roth money, brokerage account money, Social Security, pensions if you have one, they all get taxed differently, and they all interact with credits like this one differently. Third, if there's a meaningful gap between where you'd land naturally and where the credit threshold sits, talk to a fiduciary planner about whether Roth conversions in your early 60s could shift you into a credit zone. Roth conversions are a tool that a lot of Utah pre-retirees should be looking at right now, and the Social Security credit is one of the several reasons why. but they have to be done correctly. The line I want to leave you with on this one is this: knowledge without action is just information. You can know the credit exists and you can understand how it phases out and you can read about it on the Utah State Tax Commission website. And none of that saves you a dollar until you actually do something with that knowledge. At Momentum Wealth, this is the kind of thing we surface in the first hour of working with a family. Not because it's the most important piece of their plan. Taxes are one of 5 pillars. But it's not the whole picture, right? We focus on this because it's a concrete example of how a coordinated plan finds dollars that an uncoordinated plan doesn't. If you'd like a second opinion on your Utah retirement tax picture specifically, we offer a complimentary review for Utah residents within 10 years of retirement. Links in the description, no commitment, just a clearer picture. I'm Nico. Thanks for watching.